From the financial capital of the world, CNBC presents Business Center. Live from the New York Stock Exchange with Sue Herrera and Ron Insana.
The faltering stock markets are drawing most of the attention from investors, but a respected authority says something close to abuse is going on in the bond market. A story from the Wall Street Journal's Lynnette Khalfani.
In the bond world, there is perhaps no more respected voice than PIMCO's Bill Gross.
We've not only given back the flight to quality, but we've been on the increase as well.
And these days, Mr. Gross is using his considerable influence to blast what he calls a destructive force in the bond market. Hedge fund managers who are allegedly shorting corporate bonds and causing the once stodgy bond market to now move at internet speed. In his latest investment outlook publication, Mr. Gross says, quote, just as lions cull the weakest and slowest from the zebra herd, hedge fund managers prey on disabled or temporarily injured companies by shorting their bonds. Mr. Gross goes on to say that corporations with high debt levels, SEC investigations, accounting improprieties, earning shortfalls, or other blemishes are the obvious targets, and perhaps rightly so. But Mr. Gross contends that short selling is pushing bond prices lower and nudging ratings agencies such as S&P and Moody's to downgrade certain companies' debt to junk status from investment grade. And Gross says institutional investors are being forced to sell those bonds. It's a theory for which Mr. Gross concedes he has no proof, and one that is ruffling the feathers of some hedge fund experts.
That's hogwash.
Charles Gradante is head of the Hennessy Group, a hedge fund advisory firm. He respects Mr. Gross, but he says that in this case, the legendary bond guru is way off base.
I think the use of the term targeted is ridiculous. Hedge fund managers don't target companies. They do credit analysis, and if the credit analysis says that the company is overvalued and the street is missing the whole point about the balance sheet, they short the bond, and that's what should be done to make an efficient market.
Some experts say Mr. Gross is crying sour grapes after PIMCO made bad bets. PIMCO lost more than $200 million buying Worldcom bonds. And Mr. Gross admits that on one recent day, $2 billion in Sprint bonds PIMCO owns suffered a loss of a point an hour.
The speed at which the bonds deteriorate is much faster than it has been in the past. A company typically would take several quarters before you would notice a deterioration in the quality from investment grade to junk. Now it can happen in just a few days.
These comments by Bill Gross are the latest to roil the bond market. Recently, he also badmouthed the debt of General Electric, the parent company, of course, of CNBC. The criticism actually hurt GE's stock and bonds, but Mr. Gross later toned down those comments. He also wound up buying roughly $500 million in GE bonds at a substantially lower price, I might add. Sue and Ron, back over to you.
Thank you very much, Lynette.